Hi everyone, I'm Rosemary Miller here with Rob Isbitz, the founder of ETFyourself.com, here to discuss the 4 best mutual funds for 2024. Thank you so much for joining me today, Rob.
Sure, my pleasure, Rosemary.
Absolutely. So, Rob, what are those 4 best mutual funds for 2024 and what criteria did you use to select them?
Sure. So, best is an interesting word in this case because everybody has to determine what is best for them. However, I've been on Wall Street for 37 years, 30 of them managing money professionally. And when I first took on the task from Forbes of trying to figure out what are the best for next year, I was looking not just at next year but beyond, because everybody's going to interpret this differently. So what I tried to do is I tried to run the gamut of different types of funds. I used to manage mutual funds that had mutual funds. I still spend some time in that area now, but a little more focused on ETFs. But ETFs, after all, they're all index funds. And in this case, we were looking at S&P 500 index funds. So, I started with the king of all funds, and these are actually all ETFs. There are plenty of opportunities to invest in S&P index funds through mutual funds. They preceded ETFs, but we'll focus on ETFs here. So the first is symbol SPY, the SPDR or SPDR S&P 500 ETF. This was the first ETF issued back in 1993. I remember I was there, not physically there, but I've been using ETFs since this one debuted. It's now merely 420 billion in assets, and it is the S&P 500. So if somebody's looking for something, and I've heard people use these for dollar cost averaging and things like that, so that's a good place to start. You can trade ETFs on multiple platforms. They trade all during the market day, just like stocks. It's just that they represent individual baskets of securities. So I think it all starts with SPY. And one of the competitors, if you will, is the iShares Core S&P 500 ETF. The symbol there is IVV, and that one has the lowest expense ratio. I'm not quite as, let's say, bullish on using expense ratio. Maybe you get what you pay for. But I think one of the key differences, and this might be a little bit of a nuanced point for people, but if you look at IVV and SPY, they're essentially own the same stuff. IVV is a little lower expense ratio at 3 basis points or 0.03%. Okay, SPY is triple that. Still very cheap at 9 basis points. However, if you're looking to not just consider an index fund, but also things like options that you can use with it and things like that, the far more liquid options market is attached to SPY, not IVV. It's just the way it's turned out. And so it's a very subtle difference. And again, it goes back to really the overriding theme maybe of this conversation in this list, which is this is one person's opinion based on a wide variety of probably audience motivations. The third one is symbol OEF. It's the iShares S&P 100 ETF. And I'm a big fan of concentration in my investing. I don't think you need to own 3,000 stocks or own the whole market. The S&P 500 is pretty concentrated as it is, but you can go a step further by simply owning an ETF, OEF, the symbol, which takes the S&P 500 and cuts out the 400 smallest. So you're now dealing with, and especially in this era when a lot of companies have not grown by nearly as much as the biggest companies, that top 100 are a very large percentage of the stock market. In fact, at OEF, and again, this is an example to me of saying, well, I'm going to buy an index fund, but I really want to be able to track and know what I own. Well, the top 10 holdings in OEF out of the 100 are, as the time I wrote this, almost 47% of the total value of the fund. So it's kind of like saying you have two portfolios in one. You have 10 stocks for half of it and 90 stocks for the other part. And especially if you're a newer investor, it's a lot easier to follow 10, 15, 20 stocks and learn about what you own than it is 100 or 500. So that's why I like that. And then the last one was sort of the opposite direction, because again, let's try to please everybody if we can. It's a big audience, Forbes out there, and I appreciate that, and a very diverse audience in terms of what people are going there for. So the last one is symbol RSP, the Invesco S&P 500 equal weight ETF. It's 40 billion in size. It owns the same 500 that SPY and IVV do, but there is one major difference: the weighting. So it's the same stocks. However, instead of them being based on market capitalization, which is how big the company is, the price times the number of outstanding shares, where you have the Apples and the Microsofts and things like that way up at the top with a big chunk of the total assets, RSP is equal weighted. And this is going to be probably much more important in, let's call it, the post-FANG dominance, post-Magnificent Seven dominance era that I think we're probably going to gradually head into. So you take RSP, it's the same 500 as they are in the SP 500, but every stock, every time they rebalance it, is 1/500th, or about 0.2% of the basket of the index. And that means that, unlike with the capitalization weighted, the SPY, IVV, et cetera, and even with the 100, as I mentioned before, when you're equal weighted, a small number of stocks can't run the whole portfolio, can't twist it back and forth. It is equal weighted, and so that tends to give it, let's say, a little bit more of a broader, not just the very biggest companies, kind of already dipping down into mid-cap things like that. So it's just another way to own the 500 largest companies, and that's the four of them.
Well, Rob, are there any specific market conditions or economic factors that investors should be mindful of as they consider these funds for their portfolios?
Yes. I will quickly, let's keep 2024 having just left 2023 and 2022, which were sort of polar opposites. I've referred to 2024 as the tiebreaker. Because 2022 was awful, and despite a huge run-up in the markets in 23, there was a lot of breaking even over the 2 years. So here's what I would say. When it comes to the first two, because they are so similar, SPY and IVV, the S&P 500 is historically top-heavy. The last time it was this top-heavy was right before the dot-com bubble burst. Just saying, there is a limit to how much dominance a big stock market like the U.S. should have before you say maybe this is unhealthy. That would be a bigger issue for OEF because it doesn't even have the diversification beyond the top 100, so it's even more focused. And that might, if this plays out the way I'm saying, argue a little bit more for RSP, at least for this year, because the average stock, which is what RSP represents, has lagged behind the broader S&P 500 for the market cap weighted S&P 500 for a while now, for quite a while, better part of the last 5 years. So there's a different sort of watch out for with each one of these.
Well, thank you so much for joining me today, Rob.
Okay, thank you, Rosemary.
Absolutely.